Risk. It's one of the most basic concepts you're going to have to think about in investing. If you sign up for a robo-advisor, talk to a financial advisor, or really have any kind of conversation with a professional about what you want to do with your money, the first question, or one of the first questions you wind up dealing with, is going to be, what is your risk tolerance? It sounds obvious, but what does that mean? And what does it mean for you? One thing you really want to remember is that there is no investing without risk. Risk means that it's not possible for everyone to agree on what something is worth at a given moment. It makes it possible that you can gain value by holding an investment. It's also what makes it possible that you can lose value. And the level of risk is often an upside and a downside. So in order to help you understand a little bit better how to think about risk, I asked my colleague Alieza Durana to speak with us about what you can do to think about risk in your own portfolio. Alieza and I are not financial advisors. This is not personalized advice, but there are some things that you can think about that will help you make a decision that works for you. So Alieza, how do you know as an investor whether you have high risk tolerance or low risk tolerance, or somewhere in between?
So one of the ways to think about your risk tolerance, Andy, is just to imagine it as your financial limits. Do you get uncomfortable when you see or hear, about the stock market and the ups and downs that are riling investors each day? Another thing to think about is the amount of time that you also have to a financial goal. So if you are 40 as opposed to 60 or 70, you have more time to invest in stocks or something that can add growth to your portfolio and wait out the bumps in the road like we've seen in the last couple of years.
On the other side of that, though, how do I know what's a high risk investment and what is not a high risk investment?
Zooming out, when we think about your portfolio overall, usually people, allocate money into, 3 or more different buckets. They'll put some money into stocks, which is really what can help, grow your money the fastest. You'll probably put some money into bonds, which is a way to, cushion the ups and downs of stocks. And then you'll probably have some money in cash so that, you get a surprise medical bill or, your oven dies randomly, you have money on hand to tackle that emergency. So, usually you will, add more stocks or more bonds depending on how much risk you want to take. So earlier in your life, you might have, let's say, like 80% stocks and 20% bonds in your portfolio.
When I think about people I know and how they invest, I don't know that many people who are composing their own portfolios the way you describe. So are there ways that you can kind of get this balance that you're describing without going and building your own investment portfolio? Do you actually have to go in there and pick these things out yourself? Or are there ways to kind of get the balances between different risk profiles within, an existing product?
There's a whole range of possibilities depending on whether you want to be really involved in your portfolio or if you want to be super hands-off. Let's say someone like me, who's more of a passive investor. When I look at, let's say, like my retirement fund, it is invested in a target date fund, which is a specific type of mutual fund that is pegged both to my age and also to my risk preferences. And so what it does is it's a mutual fund that adjusts over time so that, let's say, as I age, they move more money into bonds and less money away from stocks, for instance. So that's probably the easiest set it and forget it option if you have, let's say, a 401k or other retirement account.
If I'm a person who's interested in kind of selecting my own investments, does that have its own risk beyond asset classes, or do I really just need to balance the asset classes?
There's risk with any investment, but there is also, more risk if you're taking a more active approach to setting up your portfolio. One of the benefits of, let's say, owning bundles of stocks or bonds in a mutual fund is that you're investing across a wide number of assets and timelines as well. But that is, you have to think more strategically about that if you're building a portfolio yourself. It's certainly easy and possible to do through an exchange traded fund. You can, buy bundles of stocks and bonds in that way, but it will take more forethought and research into thinking about, which exchange traded fund or mutual fund is a good addition to the portfolio.
So am I getting this right? Within these specific categories of investments you're talking about, one stock is not just as risky as another one. right? A company that is just starting off and has a lot of upside and strong balance sheet is different to invest in than one that's in bankruptcy and may never emerge. Can you talk about kind of the considerations in picking individual stocks like that?
Absolutely. So there are different types of risks that your investments can be exposed to. So one, with stocks or with bonds for that matter, the biggest risk is, let's say, like the company goes out of business or the stock price tanks and you lose your money. One way that you can consider that as you build a portfolio is to research the financial history, or look at a credit rating, let's say for a particular bond, that can help you assess, like, does this company pay their bills on time? Looking into, what is the credit rating or the financial history of a particular investment can be really helpful if you're picking individual stocks or bonds or another asset. But if you decide to invest in, let's say, like a bundle of stocks or a bundle of bonds through a mutual fund or exchange traded fund, that helps you overcome that type of risk, because you're buying little pieces of stocks and bonds from many different corporations or governments.
Right. So concentrating your investment is its own form of risk, right? If something goes up a lot, if you buy all one stock and it goes up a lot, you can make a lot of money. If it goes down a lot, you can lose a lot of money. If you diversify, you're blunting both ends of that. Is that right? Like, how do risks and rewards relate to each other in the way that we're talking about?
Yeah. So if you ever grew up with the saying, like, don't put all of your eggs in one basket, the same principle applies to investing. If you're buying a single stock or a single bond, you can think of that as a single egg versus, like a quiche that you might buy at the grocery store, where you slice a layer and you get a little piece of like bacon and spinach and onion. And so when, certainly, like, the more concentrated your portfolio is into like one type of asset or egg in this case, the higher the risk that if that company has a bad year, like, you could lose your investment. But if you've invested across a number of companies and you only have like one bad year for one company, the likelihood that will affect you is a lot lower. The other parts of your portfolio cushion the downturn.
What are you noticing in terms of trends and how consumers are thinking about risk? Obviously, there's been a lot of turbulence in all sorts of financial markets recently. How are people reacting to it?
The last couple of years have been really unpredictable and challenging in the markets. In 2022, we finished the year with both stocks and bonds being down, which is really unusual. Historically, it has not happened that many times. And when we think of our portfolio, usually stocks and bonds, it's like maybe almost like a seesaw. They sort of help balance each other out. But that wasn't true last year. And so a lot of people were looking at their retirement funds and thinking like, well, what happened? Like, my money is down this year. Why is that? I thought that, my bonds were supposed to protect me from other types of risk. So it's important to know that, like, usually bonds and stocks move in different directions. That didn't happen last year, but ideally you're investing over a long-term time horizon. So you should be able to wait out those bumps in the road that might happen.
Right. So low risk doesn't mean no risk, or lower risk doesn't mean no risk, right?
Exactly. Yeah.
What are some of the tools that people can use to actually think about their own level of risk? Do you recommend any kind of strategies to sort of calculate what you're comfortable with?
There are a couple of good rules of thumb about how to think about how much risk to take. In the past, financial planners have suggested, subtracting your age from 100 or maybe 110. So if you're 40, you might want to put, 60% of your portfolio into stocks and 40% into bonds, and then up the percentage of bonds over time as you get closer to retirement. So that's certainly one way of thinking about, how to balance stocks and bonds if you decide to do it yourself. But otherwise, is easily accessible through a retirement account, like an individual retirement account or a 401k, or through a brokerage account as well.
If you feel like you're behind, does that mean you might want to take on more risk to catch up or less risk to prevent losing what you have if you feel like you're planning for retirement, you don't have enough. What are some ways to think about that?
It's definitely a personal decision and something to think about as in terms of your timeline. So if your goal is to buy a house and you're saving money, you probably don't want to put, and let's say your goal is 5 years away, you don't really want to put that money at a lot of risk because you want to make sure that that full amount is ready for a down payment when you're ready to go, which is different than if you're saving for or investing for retirement and that retirement is 30 to 40 years away. So even if you feel like you're behind starting in your 30s or 40s or 50s, it's important to gauge how much time you have to that goal, in addition to how conservative or adventurous you might want to be with the risks that you're taking.
You've talked a lot about the financial, the time factors that come into play when you're deciding about what kind of risk composition you want in your portfolio. I'm wondering how much personality plays a role here. Like if you're a person who likes parachuting and rock climbing and stuff like that, are you maybe more comfortable with investment risk, or does that really not relate?
I don't know. I'm not much of a thrill seeker or gambler myself, so maybe that says a lot about me as a passive investor. But I think, probably generally it's good to check in with how willing are you to potentially lose your money? That's what risk means to you. And in some cases, you really just want it to grow a little bit slowly over time. And in other cases, you're willing to make a large bet or to take a bigger risk. So it really comes down to you.
And how do you know if you have money that might be okay to take more risks with versus money that you really ought to protect?
Usually a good rule of thumb is, before you start investing, to think about that you have any high interest debt paid off already, as well as a good cushion in case of an emergency. Sometimes people recommend having a couple months to, let's say 6 months of emergency savings in a, let's say, high yield savings account. And once you have those things taken care of, you'll know that even if stocks do poorly or there's some bumps in the road, you have the most important parts of your financial life secure and covered.
Got it. And that frees up you to do whatever you want with your money that's extra. So you could spend it on, going out to a bar, or you could spend it on trying a risky investment. These are sort of things that may not wind up giving you a positive result, but might be enjoyable or interesting.
Exactly.
Alieza and I spoke quite a bit about how risk applies to what you buy. But I want to note that another factor to take into account is when you buy. There's a concept called dollar cost averaging, which essentially means instead of trying to time the market, hope that you're buying the lowest price and you'll get the most appreciation, you space your purchases out over time in a way that insulates you from big losses, say if you bought at the top of the market. Now, whatever you decide to do, there are no right answers, and that's why your personal risk tolerance is something that only you can figure out. Talking to an advisor, reading up on it, doing your own research is going to help you determine what you feel comfortable with. There are lots of guidelines out there, but you need to think about how you're going to feel about your money if you make the right decision or the wrong decision. I'm Andy Rosen, an investing and taxes writer for NerdWallet. You should check out another one of our videos which describes some really important changes coming to U.S. retirement policy. It's on what's called Secure 2.0 Act. If you learned something from this video, please like and subscribe.